So, how's everybody doing? Hope you're all doing good. In today's webinar, as indicated on the poster here, we're talking about investing and more so where to invest your money. And specifically, we're going to talk today about ETFs and index funds. So, ETF is just an acronym for what we call an exchange traded fund. And what that means is with the exchange part is it's something that is traded on an exchange like the New York Stock Exchange or the Nasdaq Exchange or the Nairobi Stock Exchange. Any exchange that any security that is traded on the exchange is what we have that part as the exchange traded. So you trade it on an exchange. By the term traded, which is a T, it's traded just like regular stocks. That is, you buy and sell. So that's the trade part of the ETF. And then F is a fund, and a fund is mostly like a basket that contains, a lot of people's money put together to invest as one, or a basket of stocks into one security, and then that security is now considered an ETF, which is traded on an exchange, and it's grouped and managed by a fund or an investment firm. So, exchange traded funds are a basket of securities that you can buy and sell through a brokerage on a stock exchange. So they're actively traded day to day, minute by minute, and you can buy it like you buy regular stocks. There's no, like going through a specific investment fund or going through a specific broker. They are more specific. They're open to anybody who can access a stock exchange. So ETFs have been more common in recent years because with ETFs, they offer a lot of benefits. And one of those, which is more so than every one of those other benefits, is what we call diversification. So with diversification, it means this basket of securities contains several different stocks of different companies, and these stocks range from either retail, real estate, all the way to financial companies, across to whatever it is that is out there in terms of sectors. So it kind of includes almost everything for the most part, or it could be specific to a sector like the technology sector or communication sector or healthcare sector kind of companies, and they group it all together to form a basket of stocks. And this offers diversification in the sense that instead of you buying one stock at a time to create a portfolio, you can just go and buy an ETF that contains all those stocks in one basket and just buy one ETF. And when one of the stocks in the ETF goes down, another stock kind of keeps it afloat. So back to the basics of ETFs. ETFs involve different securities and assets, such as commodities, currencies, stocks, and even we have ETFs that do the opposite of another ETF. They're called inverse ETFs. So ETFs, generally speaking, can be of different types. For example, we have market ETFs, which are designed to track popular markets like the S&P 500 or the Nasdaq indices or the Russell indices or the FTSE indices, and they're all over the world. Which is, you can find ETFs in the New York Stock Exchange. You can find ETFs in the London Stock Exchange. You can find ETF across the planet wherever there's a vibrant stock exchange. So ETFs also can be bond ETFs, which invest mainly in bonds like the U.S. Treasury bonds or the government bonds for countries that are not U.S. We call them government bonds. So those are the T-bills and the Treasury bonds, and they also invest in corporate bonds. They invest in international bonds. They invest in municipal bonds and several other types of bonds. On the next type of ETF is sector ETF or industry ETF, which is it either is a healthcare ETF, or it's a technology ETF, or is a commodity ETF, such as oil, So the commodity ETFs go from oil, gold, stuff like wheat, with the Ukraine-Russia stuff that is going on. Wheat has been trading really very well and volatile. So those are sector, industry, and commodity ETFs. They invest mainly in those things that are specific to that sector that they want to invest in. So you can't find a health ETF investing in a technology company unless that technology company does something to do with healthcare. Or you can't find an ETF that is designed to invest in basic materials companies and then find a stock from healthcare that is part of this ETF, because healthcare and basic materials don't go together. So they usually segregate these companies based on their sector or industry and make that ETF specific. They can make it whole to cover everything, but that's the classification when it comes to sector, industry, and the commodity type of ETFs. Now, there's a style ETFs which are designed to track investment styles, capitalizations, such as large cap or small cap companies or emerging market companies. You would find something like Jumia on an emerging market ETF, but you won't find it in large cap value company ETF. So based on the type of the company, the style ETF segregates those stocks into those styles. Like if you're investing in emerging markets, or they're investing in large cap or blue chip stocks like Facebook, Google, Apple, you won't find a company like Jumia on large cap stocks, because Jumia is not a large cap stock. It's still growing. So under that style type of ETFs, we like I said, there's a foreign market or international emerging markets. So foreign markets is you find ETFs that are traded on the New York Stock Exchange, but they invest in companies in other markets like the Japanese market or the Hong Kong market or the London market. So foreign market ETFs, just like style ETF, are focused on a specific foreign jurisdiction, and they handle companies from that end. Now, we have also inverse, like I had said before. If you have an ETF that is tracking, say, the blue chip companies, you can have an inverse ETF. By inverse means is the opposite, as in it's like a mirror reflection, in the sense that when the blue chip stocks are going up, the inverse ETF capitalizes on the same stocks, but when they're going down. So that's where short selling comes into place. As in, they bet on the fact that maybe some of these companies will drop. And I bet you that if you found an inverse ETF for Microsoft, Netflix, and Facebook, that included mostly that, chances are you'd have done well, because Facebook dropped a huge percentage, Microsoft dropped over 30%, Netflix the same. You know, some of these companies, like even Amazon, dropped a huge margin, and an inverse ETF capitalizes on the opposite happening. So we know normally when you buy a stock, you want it to go up. But sometimes there are people who bet on the fact that it might go down, and therefore invest in that direction of going down through a lot of methods, but one of them is short selling. So inverse ETFs kind of tie into that and make you benefit on the negative aspect or the negative direction of a certain ETF. So you have an ETF that's usually designed to invest in assets that are going up, but the inverse is the one that invests in the same assets, but when they're going down, and you gain that way. Now, other type of ETFs are based on management, which is if they're actively managed or passively managed. But for the most part, ETFs are usually actively managed. They're actively managed in the sense that, unlike indices, ETFs are designed to track an index, but they want to modify a few things here and there to get the maximum performance of that ETF. So when you see when you want to invest in actively managed ETFs, the opposite of that is an index fund. Index funds, they are passively, most of them are passively managed, and over time you realize that actively managed ETFs sometimes outperform the passively managed ETFs, but for the most part, something like the S&P 500 outperforms, I think, 80% of the of actively managed funds. So type of management matters when you're choosing which type of ETF to invest in. And like I said, most of them outperform indices because they're actively managed. So the other type of ETFs are called exchange traded notes, okay, which are issued by they're backed by credit worthiness of issuing banks, and they're created to access illiquid markets. So whenever there is, stagnation in the market, whenever there is, no activity in the market, we have exchange traded notes to offer some sort of liquidity in an illiquid market. So if everything is stuck and you want some sort of short-term gains, some sort of short-term momentum, some sort of short-term developments here and there, you invest in exchange traded notes, because they have that benefit of making movements in a stagnant market. So those are some of the major types of ETFs, and I'll just recap on that. We have market ETFs, which are designed to follow big indices like the S&P 500 or the NASDAQ. We have bond ETFs, which are designed to invest in government bonds, corporate bonds, municipal bonds, and the likes. We have sector and industry ETFs, which are designed to provide exposure to sector and industry, so like pharmaceuticals or healthcare or technology or communication industry and sectors. We have commodity ETFs that are designed to invest in commodities like gold, wheat, oil, and the likes. We have style ETFs that are designed to invest in different types of, styles, in the sense that you can have a large cap, which is you just choose a certain valuation of a company, or small cap, or international, emerging markets. So that is style ETFs. We have foreign markets, which are designed to invest in non-US stocks or companies. So companies that are in the, say, London Stock Exchange, or the Japan's Stock Exchange, or Hong Kong Stock Exchange, and the likes. We have inverse ETFs that invest in the in the opposite direction of an existing ETF. So you have an ETF that is designed to invest when the stocks are going up, but you also have a mirroring ETF with that invest when the same stocks go down. So we have also management style kind of type of ETFs, which are classified as either actively or passively managed. But for the most part, ETFs are actively managed. And the reason as to why they're actively managed is to be able to outperform the indices that they track. We have exchange traded notes type of ETFs, and these are the ones that are designed to operate in illiquid markets. They're issued by banks, and their purpose is to, create momentum in the market and get capital gains for short-term periods when markets are stagnating. Now, how do ETFs work? Like I'd said before, ETFs is a basket of stocks designed for a specific reason, and how they work is the issuing company buys a group of stocks, and they choose these stocks based on either the company type, the company sector, the industry of the company, or the location, which is if it's foreign or local. They choose these companies based on different criteria, and then they make an ETF. Now, in this bucket of stocks, they group them together, and then now they say, this group of stocks, we're going to call them ABC ETF. Now, instead of buying those stocks individually, you buy that ETF, because that ETF contains all those stocks that you'd be interested in. And now, this ETF, like for example, ABC ETF, is now traded on the same exchange as the stocks that you're trading. So if you want to buy that ETF, you don't have to go through an investment firm or a mutual fund firm, whatever, those companies that offer investment services. You just, as long as you have a brokerage account, you can buy them from an exchange. Now, unlike stocks, an ETF offers a bunch of benefits, and one of them is diversification. Like I said, you want to buy company A, B, C, D, but then you realize company A is $200, company B is $50, company C is $300 a share, company D is $400 a share. You cannot, for the most part, most people cannot afford to buy all those companies at once. But because they put all these companies together, they get an average of the cost of buying all those companies. And you realize the price of an ETF is usually lower than all those companies combined because of the structure of the ETF. They make it in such a way that it's cheaper to buy the ETF than to buy individual companies. So if you're looking for diversification, investing in several companies at once, you just buy an ETF that has the companies that you're looking for. And then now with that advantage is you'd have a company in that ETF that is doing well, the ETF will go up, But if one of them is not doing well, the ETF will still maintain its trajectory. Maybe it will slow down, but for the most part, one company cannot bring it down because it invests in a lot of companies. Unlike you, if you went and bought one stock and another stock and another stock, and if your portfolio is not balanced and you realize maybe 70% of your portfolio is invested in one stock, if that stock goes down, it goes down with 70% of your account. So investing in an ETF helps maintain that stability, that diversification. It reduces risk, so it offers that risk benefits, and they're easy to invest in, unlike mutual funds and other stuff like money market funds, where you have to go to a company, talk to them, they charge you fees, they tell you there's a maintenance fee, there's ABCD fees, there's taxes that probably you have to pay beforehand. With ETFs, just like stocks, you just go to the stock market and you find that ETF and you buy it. Now, the other part of ETF that makes them good for investing is transparency, as in they offer the documents, which we call them prospectus, that shows which companies they have invested in and what their aim and purpose is. So you find an ETF that has invested in health sector companies, they'll give you a list of all the health sector companies that they have invested in, and other information to show you what is going on with that investment or that ETF. So their goals, their projections, their, if they offer dividends, how much dividends are they paying? If they offer other advantages, what are they? So you'll find that information in their prospectus, and then you can go through it and see, read through it and see what's going on, and then be informed enough to know that if I buy this ETF, these are the things I'm going to get. So it offers you that transparency, and you'll see everything, unlike money market funds, where unless you ask, sometimes you'll never know. So you just walk into a money market fund, a company, you say you want to open an account, you want to open a money market whatever account, they'll take your money, but sometimes they might give you a fun fact sheet, but after that, you'll never know what's going on until you get, information later or other releases of information. But for the most part, transparency is a little bit less there than with ETFs. Now, those are some of the benefits of ETFs. The disadvantages is some of them are a little bit illiquid, meaning if you want to sell them, if you end up buying a wrong ETF, for example, that doesn't sell, that is not active, you might end up not be able to sell them as quickly as you'd wish. Some of them have, less performance. So if you just go in and buy an ETF just because it's an ETF, you never know their performances. So you'll end up, doing worse than if you just decided to buy individual stocks. So before you buy an ETF, just do your research, look into it, see what's going on, then make the move to invest in it. Okay. So why should you invest in ETFs? Like I said, there's the risk advantages. So it reduces your risk. There's diversity, there's transparency and all that. But on top of that is ETFs are designed for long-term investing. Most ETFs are usually at least 5 years old, and some of them are usually up to 15 years old. So if you're trying to invest in an ETF for 5, 10, 15 years, if you are trying to invest for a 5, 10, 15-year goal, an ETF would be a better option than a company, one company or two or three, because with an ETF, you know they're designed to stay that long, 5, 10, 20 years. So when you buy an ETF, you know for sure this thing is going to be there. And some of those ETFs, you'll realize that year on year they've been doing good, and some of them even up to 15 years they're still doing 18, 20% a year. So 18-year-old ETFs still doing 20% a year. Unlike money market funds where they'll just tell you it's 10%, is 8%, is 9%, is 12%. But then if the market starts going down, they start reducing the percentages. And if the market starts doing good, they raise it, but they don't raise it to the market standards. So they might say, we'll give you 10%, but if market goes down, they reduce it to like 8.5 or 9. But then if the market is doing good, they don't raise it above the 10%. So they have like a limit where they can operate with money market funds. But with ETFs, if the market is doing really good, you can find ETFs that do even 40% a year, 50% a year growth for a period of like 5 years consecutively. So investing in an ETF gives you that, it opens up the return window, as in the return outcome for you, in the sense that you know for sure, yes, on a slow market or a down market, I'll be doing, probably 10%, 15%. But if the market is really doing good and this ETF can do 40%, I'll get the 40%. There's no limitations there. So you have no limits to how much you can get in terms of returns from investing in an ETF as compared to like a mutual fund or a fixed income fund or a money market fund. Those have fixed guaranteed outcomes or returns. But with ETFs, they can do 40% and you can get that. They can do 60% and you can get the 60% that year. So that's one of the reasons as to why you invest in ETFs for long term, and the return limits are, as per the market. If the market is not doing good, you don't do good. But if the market is really doing good, you realize 1 year you could be doing 10, 15%, but 2 years in a row you could be doing 40, 50%. So those are some of the advantages of investing in ETFs. Now, I've talked about ETFs, and I would want to introduce that second part, which is index funds. I've been talking about ETFs that track index funds or ETF that track indices. Now, indices or index is a classification of, like a grouping of stocks. For example, the S&P 500 tracks the Standard & Poor's 500 companies in the New York Stock Exchange. The NASDAQ index has a group of stocks that they have in that index. So ETFs and indices are the same, except for one fact that you cannot invest in an index. So an index is just a list of companies. Like the S&P 500 has 500 companies in that list. The Russell 1000 has 1,000 companies on that list, right? The FTSE 100 has 100 companies. I think that's in the London Stock Exchange. It has 100 companies on that list, but it's just a list. Now, from that list, you get now assets, stuff like ETFs. And before you get to an ETF, the closest you can get to that list is an index fund. An index fund is a replica of that list, except now that you can invest in that list. So if you get the S&P 500 index fund, is the index. It tracks the S&P 500 index, and now you are able to invest in those companies in the S&P 500. So several companies offer these indices. So you can have, I know for sure most of you have had stuff like Vanguard. Most of you have had stuff like BlackRock. I think it's BlackRock. Most of you have probably heard of companies like Fidelity, Charles Schwab. You know, these are some of the companies that come up with these index funds to track either the S&P 500 or the Nasdaq or the Dow Jones Industrial Average. So these indices, you get an index, which is a list, and then an index fund is a replica of that list, except for the fact that you can invest in that list. And companies that offer these indices are stuff like the Vanguard, the ProShares, which is under BlackRock, Charles Schwab. We have Fidelity. Those are some of the major indices and ETF providers. So with that, when you're looking for an ETF, you'll find the ETF house. We call them the house, as in the provider. Yeah. So you find a provider, and some of the best performing providers are like the Vanguard. They do really good. So if you go to the Vanguard, you can find an ETF for the S&P 500 or an index fund for the S&P 500. Or you go to iShares and you find the same indices for the S&P 500 and whatever index that you're trying to look for. You go to Schwab, Charles Schwab. We have Invesco. We have Fidelity. You know, those are the major stuff. We also have stuff like what is the other one? I'm forgetting another one. But those are the major ones: Charles Schwab, Invesco, Vanguard, and ProShares, which is managed by BlackRock. So when you're looking for these indices, index funds, and ETFs, you go and look for stuff that are managed by these companies. Now, like I said, index funds are the beginning of those type of assets. So an index fund is a list that you can invest in that tracks an index. Now, index funds are broad. They're just, it's like you get the S&P 500 and you get the S&P 500 index fund. It's like mirror images. But then an ETF is more specific. It says, oh, out of those 500 companies, which of them are healthcare companies? We only want those ones. So you have the S&P 500 healthcare companies ETF. Or you say which ones of those are only technology companies, and you pick out the technology section of that index, and you call it a technology ETF. For example, we have the Semiconductor ETF. I think the ticker symbol is SOX. SOX. We usually use that sometimes. SOXX. That's what do you call it? An ETF that tracks semiconductor companies, stuff like AMD, stuff like NVIDIA, stuff like Intel, you know, stuff that deal with semiconductors. So yes, those companies exist in the S&P 500, But because the ETF is more specific, they chose only the technology, the semiconductor companies. And they said, we only are interested in this out of the 500. And then if you go into like basic material companies, they'll go and pick only those companies that are related to basic materials, stuff like, stuff to do with like building and construction materials, steel companies and all that. They pick only those and put it in an ETF. Now, I've talked about index funds. For the most part, index funds and ETF, apart from the fact that index funds are more direct replicas of the indices they track, the other difference between ETFs and index funds is ETFs are traded daily, just like regular stocks, any time of the day, as long as it's on a stock exchange. But with index funds, they are traded based on the end of day price. So you can find an ETF today that is, right now it's probably $400, but 2 hours later it's $415, and you can buy and sell like that. But with an index, they wait until the end of day, they get the price of that index, and they say, now you can buy this index for this much price. And then once you buy, you wait until the next end of day price to either sell it or buy more or do whatever you want to do. So the differences between ETFs and index funds is ETFs are more flexible. You can buy them anytime, you can sell them anytime. But with index funds, the buying and selling price are more fixed to end of day prices. So let me see. ETFs, index funds is a broad topic. There's really a lot that goes into what ETFs and index funds are, and trying to figure out how to invest in them, which way to, which tools to use to, look for ETFs and index funds to invest in. What criteria do you use to screen out what ETFs to invest in? So all that is, I would say, a different topic. So just like we did with stocks, how to screen for stocks, we'll do how to screen for ETFs, how to screen for index funds, what are the criteria and tools to use to separate the good ones from the bad ones, kind of thing, or choose and segregate them to a point where you're like, I like these ones and I don't like these ones, and these are the same, but these and these ones are not, So with what to do or how to track and choose ETFs, we use also Finviz, and we also have Morningstar. But all this, I think, should be on the next topic, because as of now, the time has gone by so fast. I would like to probably just answer a few questions that we got before the webinar started, and then answer more questions from you guys, and then speak a little bit about our own fund, which is a SPIF, Small Pooled Investment Fund. So we will tackle that after I talk a little bit about the questions that were asked, and then any other questions that you have, and then we'll go the SPIF. So from what I gathered, there's a question about, what was the question? Oh, dividends. and how do you get the dividends? How do they get reinvested? Currency wise and all that. Now, when it comes to dividends, so if you are investing in a dividend oriented ETF, they usually either offer dividends quarterly, monthly, weekly. There's ETFs that offer dividends on a weekly basis. So these ETFs, they offer dividends, and you have an option to either reinvest the dividends or to cash out, as in get the dividends. So there is what we call dividend reinvestment plan, which is DRIP. I think that's what most people call it, DRIP, which is dividend reinvestment plan. So if you choose the dividend reinvestment plan, when you receive the dividends, they straightly go and buy the same ETF. Or, you can choose to have it in your account, and then you choose what to do with it. Now, if you choose to receive the dividends, now your broker is then the one to determine how you're going to receive it. Some of them usually just credit to your account, and then you can withdraw it if you want, or you can, transfer it through different methods of money transfer to your bank account and get it in cash. Now, your brokerage accounts operates, if you're having an Interactive Brokers account, it operates with dollars. So the currency that you'll receive is in dollars. And then now, when you withdraw it, based on your location or your local currency, it will then be converted by your bank or whatever financial institution that you're dealing with into currency that you can use and transact with locally. So the currency comes in dollars, and then you can decide what other currency you want to convert it to. So that was one of the questions. The other question was investing for long term and investing for family and most especially kids. So if you're investing for long term, like I said, ETFs are good for long term investing, in the sense that ETFs have been on the market. Some of them have been on the market for 10-15 years. So if you're planning to invest in an ETF, you find one that is active, that has been formed in the last couple of years or so, because that's going to last another 5-10 years. And then if it's a good one, you can hold it for the next 10 years. But if you don't like it, eventually maybe they stop giving out dividends or something happens, they're not performing well, you can just get rid of that ETF and buy a different ETF. So with ETFs, it's more flexible. You can buy and sell whenever, however. But if you are trying to do a long-term investing, you can use that. Now, with investing for family and most especially kids, Interactive Brokers offers those accounts. So you can have one account, which is your main account, and you can have sub accounts, which is accounts that you form after, or you open after you've opened your existing account. And you can choose the reasons as to why you want to open a new account. And one of those reasons could be, I'm investing, for my kids' education, for my kids' emergency fund, for my kids, whatever it is that you want to do. So Interactive Brokers offers you that option. And then you can now list your kids or next of kin, which is either your kids or your spouse, to be the custodian or beneficiary in case something happened to you. So having an account, either it's a retirement account, is an individual account, is an account for your kids, whatever account that you're having with the Interactive Brokers, they usually ask you for a beneficiary in case something happened to you, and you can list them. There's that option, and you can list them. There's that option. If you would like me to get into that details on a personal level, I'll let you know how to find that point. But like I said, you have the option of adding a person to where if something happened to you, they can contact that person and make arrangements for stuff to happen. So that's the question that I got about investing for your kids or family members. If you are a group, that's the other thing. If you are a group of people, maybe you are like a chama, or you're like a whatever it is that you have as a group of people, you can also open a group account and invest as one group, and you know how you handle your finances before they get to a brokerage like Interactive Brokers. So that too, you can have directors for your group, and you can have people who are responsible to take care of the investing side of things. And then now, if something happened to either one of those, we know there's another person to take care of that.